Okay, so what is the possible link between interest rates and movements in a currency's value? Let's spend a few minutes looking at this important idea. Here's a chart showing the value of sterling, GBP, Great British Pound, against the US dollar since 2021. You can see that in 2021, all through to the sort of autumn, the pound was falling quite sharply. Indeed, the pound was threatening to reach parity against the US dollar, where £1 would have bought a dollar. Since then, the pound's been appreciating, and it's stabilised at around $1.30. Now, lots of things drive the exchange rate: fundamental economics, investor sentiment, but a key factor is interest rates in the UK, and interest rates set by the UK Central Bank, Bank of England, relative to other official interest rates. Here's a quick overview. Let's go back to December 2024, so not too long ago, showing the rate of inflation in a number of countries. China pretty low, Sweden low, Russia obviously much higher with a weaker currency. And the central bank interest rate. So the interest rate set by the central bank, the sort of benchmark policy interest rate in a bid to control inflation or try and meet other macroeconomic objectives. Now, when interest rates go up, normally, other things being the same, ceteris paribus, a currency appreciates, it becomes stronger. Why does that happen? First of all, higher returns. Investors tend to put their money in countries and currencies with the highest expected real rate of return. So they tend to move their financial assets into bonds, shares, property, bank accounts, denominated in a currency with rising interest rates. It could be the interest rate on a government bond. It could be the interest rate on a deposit account with a commercial bank. Now, if investors start doing that, they demand that country's currency to invest in the higher yielding assets. Foreigners must buy the currency, therefore increasing its value in the currency markets. And another factor is that if monetary policy becomes more deflationary, inflation hopefully comes down, higher interest rates slow down inflation, which helps to maintain the currency's real purchasing power. And again, that tends to make a country over time more attractive to inflows of financial capital. So often the higher interest rates in a country cause an inflow of hot money. That's just investors looking for the highest risk-adjusted return on their money. And a nice user way of showing it is to use currency supply and demand. This is the pound against the dollar. If UK interest rates go up relative to the dollar, you tend to find that there's an influx of money into UK banks. So the demand for pounds goes up, D goes to D2. Other things being the same, you'd expect the exchange rate to appreciate. So you can just use simple supply and demand to explain it. Conversely, when central banks are cutting interest rates, the opposite tends to happen. Investors might decide there are better yields elsewhere and move their capital to countries with higher interest rates. So that instead of buying pounds, they now might be selling pounds. The supply of pounds shifts out and the value falls. Okay, and often again with lower interest rates, over time that leads to higher inflation, which makes the currency's real value less attractive. So a good example really is the Japanese yen and many years of ultra low interest rates, including a period of time when interest rates have been negative. So the Bank of Japan has been struggling to keep the Japanese economy out of fairly persistent deflation. They've kept interest rates very low, negative at times, and as a result investors seek higher returns overseas, and that tends to weaken the Japanese yen against the US dollar and the euro. But it's not just the absolute level of interest rates that matters. The key thing for your analysis is the difference or the differential between interest rates in two countries. And there's something called the carry trade. A carry trade happens when investors borrow money in a low interest rate currency and they buy currencies offering a higher yield. Let's say Japan has 0% interest rates and the United States has 5%, and that's been pretty recent. Well, investors might borrow money in Japan, very cheap, and invest in US dollars with a higher return. That increases the demand for US dollar and weakens the Japanese yen. And a good example here is Australia. Australia typically, largely on the back of very strong growth in China, has had higher interest rates than Japan. Traders will borrow in Japan and invest in Australian assets, causing the Aussie dollar to appreciate and the Japanese yen to weaken. And just to give you a little bit of a flavour on the data side, look at that. That's since 2016. Japan, Bank of Japan was following a negative interest rate policy. I mean, not massively negative, but minus 0.1. It's just only recently that they've moved out of negative territory as inflation has picked up in Japan. And you can see that since 2020, again, the data is just the last 5 years, but in nominal and in real terms, the effective exchange rate index of the Japanese yen, that's the value of the yen against the basket of currencies, has fallen really quite sharply. So very, very low interest rates in Japan has been a factor causing the Japanese yen to depreciate. So short-term currency values react immediately to interest rate changes, investor speculation and capital flows. Money moves freely around the world economy. It moves at frightening speed often. But in the long run, the effects depend on economic fundamentals, the impact of interest rates on inflation and shifts in countries' trade balances. Good example is the euro. So the European Central Bank, member nations who have joined the single currency, if they raise their policy interest rates, the euro may strengthen in the short run because money flows into commercial banks in Germany or France, or Spain. That's known as hot money. But persistently high interest rates can actually hurt growth in the European Union. There's been some criticism of the European Central Bank, for example, of being a little bit slow to cut interest rates at times of economic danger. And if growth is hurt, if growth is weak, the profits from real investment are damaged, and consequently long-term depreciation could still occur in the European currency. So there are relationships. It's important to understand the key relationship between interest rates and exchange rates. Typically, when interest rates are going up, a currency tends to appreciate, and when interest rates are falling, as in the case of Japan, negative, then you get currency depreciation. It's one factor in the exchange rate market, but it's one that the examiners often ask about. Okay, so thanks for joining in. Stay safe, stay curious, and see you sometime soon.